Always the most important. Let's have fun. Let's get some good education under our belt. A lot of that falls to me, but you guys always help me with the education as well, so I'm not concerned about that. Let's get ready for the weekend, see what next week going into September of 2020 has in store for us. Now, as I mentioned, I had 2 comments that came in the last 24 hours on the earnings video that we had posted, the best strategies for earnings, which was last week's discussion. And we posted the archive for that on Monday or Tuesday, I believe, but a couple comments came in. PK wanted to see a video on risk reversals. And TinyPirate, in relation to our discussion on Long Straddle, said, I haven't found anyone who thinks buying straddles is a good idea. You need such big movements to break even, let alone profit. I am unsure how you pull this off. That discussion was related to what Ernie had been testing, what we talked about with long straddles for earnings and his basic approach compared to doing short strangles, iron condors, or trying to sell into the implied volatility. In any case, we're going to take both of those right now, and they're going to be pretty quick. So for PK, the basics of the risk reversal, let me put this over here. There we go. Let me move that over there. The basics of a risk reversal is I'm going to sell an out-of-the-money put, maybe 5 to 10% out of the money, essentially like a naked put. And at the same time, I'm going to buy an out-of-the-money call at a lower price than the put attempting to get a credit. This is very similar to a synthetic long stock, where you'd short the at-the-money put and buy the at-the-money call and hope to get a credit. But it's a little different because you're using 2 different strikes. It gives you unlimited upside. You have to pay the margin requirement or have on hold the margin requirement to cover the naked put obligation. But this creates a dead zone, not a death valley, what we sometimes refer to when we're talking about the long straddles, of course, as I mentioned, or even the butterfly positions. But it does have a dead zone. And a lot of times people discuss this in a term of a volatility skew, meaning you're trying to fund the price of the call by selling the put option, and the out-of-the-money put, in theory, would hopefully have a higher implied volatility. So here's a standard risk reversal, a long risk reversal. You can do this on the short side as well. Sell an out-of-the-money call, buy an out-of-the-money put, and it's a synthetic short stock with the dead zone in the middle, as you can see. Well, at Apple trading at 575, I just took a range. Let's just go 6-7% out of the money, 30 points on both sides. Sell a 14-day out 470 put for 663. Buy a 530 call for 838. Now, this is a debit of 175. Okay, this is probably not what PK had in mind. As I mentioned, you probably want to do this for a credit. But I have to cover the 470 strike. That naked put position down here, I've got to cover the margin requirement for that position. And of course, if the stock does move up above 530, I start to see the infinite profit to the upside. Well, really, 531.75 is that upper break even because this was entered at a debit, not a credit. All right. So it wants to be done at a credit. Well, let's keep the same time frame. And say we want it to be 10% out of the money on the put. We don't mind getting put Apple if we want to own it, but we're going to go 10% out of the money to hedge against a decline. So we sell the 450 put for 14 days out, which is only 328. The next out of the money call strike that's available for that same expiration is the 580 call at a price of 264. The 575 was bouncing around 330, 325. So we went with the 580 at 263. Now you've got a net credit of 64 cents. But to be cash secured on the put, you've got to put up $44,936 per contract to make $64 if Apple ends up in the dead zone. And what's the dead zone? It's 130 points essentially from 450 to 580. That's only a 0.14% return in this case. Maybe you could get a better price, of course, if you went 5% out of the money and then only had to go 8 or 9% out of the money with the call. You'd still get a credit. The dead zone wouldn't look as big. But I'm showing this as an example that if you wanted the put to be 10% out of the money, you're not getting a lot of good premium here. You're not getting a good return on the investment. This really shouldn't be done unless you have some type of portfolio margin or a very low margin requirement for cash secured naked puts, or naked calls if you do the reverse. One of the comments I did mention in my reply on YouTube to PK was that although this is a strategy that's like the synthetic long stock position or the synthetic short, if we reversed it, it is commonly not used by retail investors, and you can see why just in this range of the dead zone and the monetary requirement, unless you're using a drastic amount of margin or portfolio margin on a naked put or naked call position, which is not advisable. All right, a little bit more complicated, but then we'll move on. Why is it a volatility play? Well, what you're trying to do here is hoping that the put that you're selling, in our example, the 450 put, which has a volatility of 0.51, we're looking at the volatility skew tool here on power options. You want that to be higher than the call. Well, in this case, if we targeted 10% out of the money for the put, because we didn't think the stock would fall that far, and that has a volatility of 0.51. The 580 strike that gave us the credit has a volatility of 0.57. So what I noticed in this case, if you're trying to follow that specific rule, you're actually going to be down here to get the volatility play in the 510 or 520 range. But that's going to be a debit of about $1,900 or $2,000, which is not what you want. It got very complicated. You're trying to do all these things to make this work. Maybe Apple isn't the best stock. Okay, but in this example, with a volatility smile that you kind of see here, what does that mean? You see the out of the money options have the higher volatility. You get to at the money, it's lower, then they start to creep back up as you go out of the money towards the calls or in the money to the puts. We see a slight smile. Maybe you need a skew to make this work rather than a smile. But in any case, it didn't work. Also, that infinite upside that we saw, on the profit and loss chart here, for this particular trade is 16% out of the money. And this was only a 14-day trade. That is a very, very speculative guess for 14 days. A 16% move in 14 days, unless maybe earnings are coming up. But you wouldn't want to do this with this amount of risk going into earnings. You'd want to protect that somehow. Maybe do a bull put credit spread with the long call. But then you wouldn't be at a credit again. All right? So we need to go further out in time. We go out to the October series, about 49 days out. And again, we look for a skew there, or smile, but right around, I looked at the 425 put. The 425 put had a volatility of 0.52. That's the one we'd be selling. And then the at the money 520, just out of the money 520, had a much lower volatility around 0.49. Okay, so that matches category one. Is that going to be a credit? No. Now we're in a debit of $1,900. We're only getting $880 for our far out in time put, our October, deep out of the money put with the higher implied volatility, $880, and we're paying $28.40 for that near term 520 call. Hey, not too bad of a break even, $539, but you're at a debit of, let's call it $2,000. And the same pretty much close margin requirement to cover the naked put position in that case. If you did as you know, if you do the straight synthetic stock, you also have the margin requirement for the naked put. Okay? So what is the best credit in October? Assume again we go 10% out of the money on the put, we can collect $14.50. Ironically, the way the prices worked, the first call for a credit is the 580 call in October, the same 130-point difference or structure we saw for September 14th. But now we're getting a credit of $183, okay? But there's still 130 points of the dead zone, where yes, we could make $130 if both options expire worthless, but you got to put up that margin requirement. So for 49 days, if the stock stays between 450 and 580, where are we? At a 0.4% return. This again, I'm showing repeating this because the comment I made. This is why most retail investors don't use this strategy, because we can do better than 0.4% for a 49-day trade, typically. Risk reward. Does this give an infinite upside? Yes, but not unless the stock goes above 580. Okay, we're at that 16% out of the money range, even though we gave ourselves 49 days. Okay, so this is the concern that I have with this kind of structure, with the risk reversal, the long, in this case, like a synthetic long stock, or if you reversed it, the synthetic short stock in that case, okay? So my not so final thoughts, because I haven't tested it, but just looking at the basic structure for PK, this risk reversal idea, selling an out of the money put, buying an out of the money call to create a synthetic long with a dead zone in the middle, it wants to be done at a credit because the debit dead zone is bad, all right? In theory, you want that IV in your favor, but 4 or 5 stocks that I looked at, after I saw that Apple wasn't giving me what I want, it felt like putting a square peg in a round hole. There weren't that many where you went 5 to 7% out of the money on the put to 10% out of the money on the put and found a call at a credit where the implied volatility was lower. It was actually even or higher. It didn't work out right. It does seem that you need a longer time frame because the structure we saw, forcing the call to be 16% out of the money if I chose that 7 to 10% out of the money put, I want 50 to 60 days to give the stock time to move that 16%. And if I am expecting a 16% move in a stock in a 14-day or 40-day period, just buy the stock. Avoid the dead zone. You've got to put up the margin requirement for the naked put anyway, so why not just buy the stock? The stock moves up 5%, you've got a 5% profit. On the risk reversal we just looked at, it would be a 0.2% profit, right? Until it started to get above that higher strike. If you wanted to hedge the stock and leave the upside open, you could buy a stock, sell an out of the money call like a covered call, and then buy a higher strike call with a bear call spread. That would leave the upside open, give you a little bit of hedge and a little bit of premium on the position. Or buy the stock, 200, 300, 400 shares, and just sell half the calls. Buy 400 shares, I sell 2 calls, I leave the upside open. I have a similar graph to what we just looked at with the risk reversal, but most of it is all in profit as the stock moves up in price. Okay, so that's just what I wanted to go into that with the first, just a couple minutes there for PK on my initial thoughts. And then, of course, as we discussed, my not so final thoughts without testing. I think there are better ways, depending on the structure, that you can get to do that. Now, very quickly before I get to your question, we're going to review this fast, but as always, very thorough. TinyPirate's comments on the YouTube video is, I haven't found anyone who thinks buying straddles is a good idea. You need such big movements to break even, let alone profit. True. I'm unsure how you pull this off. Well, my direct answer in the comments is we have seen good success through testing and Ernie's trading. I do a little bit of this following Ernie's rules, but in any case, doing any type of earning strategy, whether you're doing long straddles, whether you're doing short strangles, whether you're doing iron condors if you're selling into it, which I don't recommend, but you might be making a profit, as TinyPirate suggesting, and probably is if he's doing a different strategy. You want to make sure that you're only doing that with a small portion of your portfolio, 3, 4, maybe 5% at most. You're trying to play a lottery ticket, essentially, okay? So in any case, many straddles around earnings can be too expensive. And in the video, we showed that view of the upcoming earnings where we have presented the at-the-money straddle price if that debit percentage, meaning the total cost that you're paying for the straddle, is less than 7%. I typically do not and would never get into a long straddle around earnings where the percentage I'm paying against the stock price is 10, 12, or 15%. I wouldn't make that trade. TinyPirate is absolutely correct. There are criteria involved to do this and to do it effectively. But in any case, using short strangles, I would never suggest a short straddle, but using a short strangle around earnings can lead to small profits and small percent profits based on the high margin requirement, as we just saw with the risk reversal. But it can also result in large losses, wiping out gains of many previous trades when the unexpected hits. Here's an example. I came across this yesterday. A customer of mine emailed in. He had a 235, 240 bear call credit spread on ULTA expiring today. And he emailed me after hours and said, ULTA just jumped 40 points to above 255. How can I repair my bear spread? He's at 235, 240. Well, he's going to take the maximum loss. Thankfully for him, as you can see, the day went on. The stock pulled down significantly after the initial jump. It was very fast, but got out with a small loss instead of not the maximum loss, so that was good. But in any case, it hit 256 at the open, closed up $14.50 at the end. A Okay, so it's only up 6.5% at the end. As you see there, it's about 237, 238 roughly at the close. Okay, so long straddle versus short strangle. August 21st, 7 days ago, ULTA was at 214. I would have bought the 828, 215 at the money straddle. Same strike for the call and put, 215 strike. The call, I believe, was 1055. The put was 1105, so my total debit would have been 2160. The short strangle, and I gave a credence here to go 15% out of the money for protection. So on 828, so on 821 with a stock at 214, we would have sold today's expiration with a short earning strangle, the 182.50 put at $1, and the 245 call at 170. So we roughly got a net credit of 270. But the margin requirement is 245. Actually, it might be 246, depending on your broker. Every broker is a little bit different. Some do a third of the cost or 2/3 of the cost of the short call, or whichever's higher, okay, in that case. And, okay, I'm just looking at some of these questions here. Okay, William, I'll get to yours in a comment, and we'll go backwards, okay? All right. Okay, I'm sorry, guys. I see that some of you sent your questions twice. I see all of them. There's about 12 questions already in here. We're going to get through this part of the presentation first, and then we'll come back to everyone. So I see all of your questions there. I've got many questions from Kip, William, Octavio, Maurice, and a couple others. But in any case, let's go back. So initially, a broker might charge you the strike of the call plus the premium of the put, and then if you have margin, you can take portions off of that. But again, it's going to be a high margin. Monday, August 24th, ULTA's at 222.50. The long straddle, the call is at 1470. Puts at 770. I could liquidate right there for a 3.7% return. Okay? The short strangle, the put was at 35 cents, so I could buy it back more cheaply, but the call was at 275. So it cost me a 305 debit to close. I'm at a loss of 30 cents or 11% of the 275 total credit I received. Very small amount compared to the huge margin requirement. Okay. All right. August 25th, stocks at 219.78. Long straddle, 13.50 and 760. 21.10 liquidation value, loss of 50 cents or 2.3. In this case, now the short strangle has had 3 or 4 days of decay. The put was only at 45. The call was at 2. It cost us 245 to close it. So we'd make about 25 or 30 cents. A small gain against the huge margin, but 11% against the initial credit. Well, it goes like that until this morning. Remember where I'm at. I am at a long straddle at the 215 strike, okay, with a cost basis of about 21. So my break even's about here. The short strangle was at, what did I say, 245 did I sell? Yeah, the 245 strike. It's right about here. And the 182.50. I know it's not an accurate presentation, but it opens at 256 after hours, and it opens here. If you're in this strangle, what are you doing? You're likely jumping in and scrambling to buy this. Now, you'll eventually see, as Sam had mentioned, on earnings or even with his straddles, you look at the first couple minutes or the first 15 minutes of the day, you can start to see trends say, oh, okay, it's pulling back, it's going to pull back. But at this point, you're down $11 to $12. It's going to cost you $11 to $12 to buy back that 245 call in this case. All right, once it got up to 256, it was about 12. I'm sorry. Yeah, once it got up to 256, we're around $12. You only took in 270. Okay, so you're at a significant loss in this position. You've probably wiped out the gains of 8 or 9 previous trades, and you're scrambling so the loss doesn't get bigger. Okay, but if you had the guts to hold on, then you start to get a little break even. Okay, you start to look better. And by the end of the day, you've got that full profit of $2.70 off that margin of $24,000. This was looking extremely good at the open and even in the first 15 minutes, even after it started to pull back. Now, that's a significant move. I understand. But this is what I wanted to show, is that Ernie's testing is usually right or makes a profit on the long strangles 52 to 55% of the time. A lot of the winners are 150 to 200% gains. A lot of the losers, well, not a lot, but a fair amount of them, and then this one here is almost 100% gain. when the stock first jumped up at the open, and even after it peaked at 256 but came back down, you could still get a good price and close it for about $40. That would have been a return of $18.40 on your $21.60 investment, or an 85% return. Not all stocks move this far, I understand. Now, around 11, the stock was at 241. Okay, the 250 call was at 25.95. So this is still a 20% return if you didn't get out right away. Those of you who have been following our basic discussion on the trading of these straddles and everything, you say, do you get out right away? Yes, especially with a movement like this. You don't wait to the end of the day. You get out when you see the jump that you want and try to pin the direction. There's a lot involved in it. That's why Ernie's working on a product for it, okay? But again, the short strangle at the peak, the stock's at 255-ish. It was around 10.10 to buy to close a 245 call, so it'll be a loss of 735. Again, at 11, the stock was at 241. But the liquidation value was about $1. So you're gaining $1.75. You could have liquidated early and taken the profit of $1.75. And you would have had a full profit if you held it to the end. But again, a profit of $1.75 or $2.70 off of the investment, the margin of $24,400 or $24,535 in that case. Okay? 1% return. Is it worth it? I don't know. All right. But this is one example. And TinyPirate's absolutely right. If ULTA would have only moved up 5%, that cost that I had, that $21.60, was about 10% of where the stock was when I would have opened the straddle. I wouldn't have opened it personally. And if the stock only moved 5%, I'd be down 50% on that position. Okay. And Sam says any return is better than a loss. You're right. No, Sam, this wasn't a day trade at all. This was buying using what I discussed about the long straddles in the earnings play from last discussion. This was if I had opened both of these positions on August 21st following the rules. Of course, in this example, had I gone 10% out of the money for the short strangle in that position, let me just go back a couple real quick and then we'll move on. If I just gone 10% out of the money, when the stock was at 214, so I would have been at the 234 call, roughly 235 call, and slightly lower on the put. Well, the stock at 238, I would have had to close for $3 or $4 today at the end of the market. I would have received more credit up front, so I might still be at a profit in this case, but still probably not as high as the straddle was in that situation. Okay, all right. So Fernando has a comment here. Long straddle. Buying a straddle also allows you gamma scalping with stock for paying theta decay or for buyed options. Okay, so you can use you're right, you can use the stock in the sense of a long straddle to help with decay and to help with management techniques. You can do that in the short strangle too, in a sense. If I'm in that short strangle and it's not working out, I can buy a stock and I sort of create a covered call with a naked put, what's called a covered combination in that case. Sam has been very profitable to straddles, but they weren't earning straddles, which was what TinyPirate's question was in that case as well. Okay, so I thought there was another one here. I'm going to go back real quick to William. William had a comment. You guys have all the questions in here. I'm looking for William's. Yeah, Sam also added in relation to that, he says, I like the straddles long term. Sam's talking about straddles and strangles long term, buying straddles and strangles long term on SPY, meaning a month or 2 months or a couple weeks out in time, and then playing the straddle. And he's been extraordinarily successful this year doing those, both in the downturn and in sort of the recovery as well in that case. So that's very profitable. The short straddles and short strangles would have been harder to manage in that position. Okay, but Sam did comment he didn't want the reversals in that case. Okay, there it is, William. William says, regarding, I'm going to go back just a couple, and then we're going to get to the live questions. And this is sort of live questions, live comments. Let me go back. Oh, sorry, there we go. I want the one with the Jolly Roger in it there. All right, so regarding the risk reversal, William says, could one do it with a put credit spread instead of a naked put to reduce the margin? Yes, but you wouldn't be getting a credit at that point, most likely. I did kind of mention that, but I glossed over it. So if I had to pay the money now, I collect $14.50 on the October 450 put, and then I pay $10 for the 440. That's probably more than that. Let's say $12 for the 440 to do the bear call or the bull put credit spread, and then pay $12.68. I'm in a deep debit in this case. Okay, you're not going to. You could, William. That's absolutely one way to correct the margin, but that's going to be a very bullish move. This is a very bullish strategy anyway, and the dead zone is now going to be a high debit. Okay. And Sam also mentions that what about you could potentially sell 2 naked puts in this scenario, or do this, sell the 1 put and do a bull put credit spread, perhaps, to try to keep the credit. There's different ways you can build it, but the straightforward risk reversal is just what I was looking at. And Sam does comment, says maybe this trade, this risk reversal with SPY, and if SPY goes south, can manage with other long puts and other adjustments as well. Okay, so let me just go down to the bottom. That's fantastic. All right, so there we go. That's all that we had there. And in relation to those YouTube questions, excuse me, for PK and for TinyPirate. So not every position is going to be profitable. I agree. Not every long straddle for earnings is going to see a 80, 90, or 100% return, but you may see some return before you close it out. And a lot of them may come off instantly as a 75 or 80% loss. But to me, it beats the monetary requirement of trying to do a short strangle position with the high margin, unless you have portfolio margin or a ratio discount that you use in your margin requirements for naked calls and naked puts with your broker, which could come back to haunt you in a situation if, like ULTA, if it gapped up to 256 and then kept going. That could be very bad margin call.